Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve has fundamentally altered the investment landscape. After three consecutive quarter-point cuts in late 2025, the Fed has held its federal funds target range at 3.50 to 3.75% for three straight meetings. This pause has triggered a complete repricing across Treasury markets, derivatives, and equity sectors. Here's what traders need to know right now. Start with Treasury yields, because this is where the most dramatic shift is playing out. According to Federal Reserve H15 data and market sources, the 30-year Treasury yield has surged to 5.1 to 5.14%. That's a level we haven't seen since 2007, nearly 19 years ago. The 10-year is trading in a 4.57 to 4.67% range, while the 2-year sits at approximately 4.09%. This isn't just noise. The 30-year yield hitting 2007 levels reflects a fundamental reassessment of long-term inflation expectations and term premium requirements. Market participants are demanding higher compensation for duration risk, and that's reshaping portfolio construction across the board. The yield curve dynamics tell an equally important story. As of April 30th, 2026, the 10-year is yielding roughly 0.52% more than the 2-year. The curve is normalizing from its inverted state, though we're still below the historical average spread of 0.80% since 1977. This steepening process is in early stages, and it's creating specific opportunities we'll break down. Now let's talk about what derivatives markets are pricing. Federal funds futures have undergone a dramatic recalibration. Market participants have completely eliminated expectations for additional rate cuts in 2026. Zero probability priced in through December. This is a massive departure from earlier positioning when 2 cuts were widely anticipated. According to research from LPL Financial on fixed income markets, institutional investors have shifted preferences toward high-quality securitized markets, particularly agency mortgage-backed securities, over investment-grade corporate bonds. This rotation reflects concerns about credit spreads and the relative attractiveness of government-backed securities when rate expectations are stable to potentially rising. The sector rotation picture is where actionable opportunities are emerging. Financial stocks are the primary beneficiaries of this environment. Banks and financial institutions see improved net interest margin outlooks as the yield curve steepens. Regional banks show even greater sensitivity to these moves than large money center institutions. If you're positioning for continued curve steepening, financials offer direct exposure to that thesis. Technology sector performance is diverging sharply. According to Yahoo Finance data, NVIDIA declined approximately 1.90% in recent sessions amid broader semiconductor sector concerns, while Apple advanced roughly 1.26%, demonstrating resilience among established tech leaders. This divergence is critical. Investors are becoming discriminating within tech, favoring companies with strong balance sheets and established cash flows over high-growth, high-valuation plays. The growth-to-value rotation is accelerating. Dividend-sensitive sectors are receiving increased attention as investors seek income-generating assets that can compete with rising Treasury yields. Healthcare and utilities are experiencing renewed interest as defensive plays. According to sector rotation analysis from investing.com, momentum status across S&P 500 sectors shows clear preference shifts toward value characteristics. Let's address cryptocurrency positioning. Crypto markets have found renewed support amid traditional market uncertainty. Some investors view digital assets as portfolio diversification tools, and the research suggests crypto is experiencing relative decoupling from immediate interest rate cycles. However, volatility remains elevated, and institutional adoption varies significantly across asset managers. Fixed income strategy is where active management becomes essential. The current environment favors duration management in response to yield volatility, credit quality emphasis amid spread concerns, and securitized product opportunities in agency markets. According to CME Group's Treasury futures data, traders are actively repositioning across the curve to capture relative value opportunities. Risk factors remain front and center. The Fed's pause reflects confidence in current inflation trends, but vigilance for resurgent price pressures is essential. Future policy decisions heavily depend on incoming economic data, including employment figures, GDP growth rates, and inflation metrics. The current pause provides flexibility to respond to changing conditions without predetermined commitment to a policy path. International context matters. Global central bank policies continue influencing U.S. market dynamics. European Central Bank and Bank of Japan decisions affect relative currency valuations and cross-border investment flows, creating ripple effects across Treasury markets and equity sectors. From a portfolio construction standpoint, successful navigation requires active management and careful sector selection. Financial sector exposure benefits from steeper yield curves. Selective technology positioning favors established companies with pricing power and cash generation. Defensive sectors provide portfolio stability when uncertainty spikes. According to research from BlackRock on Fed rate cuts and portfolio implications, interest rate sensitivity analysis across portfolios is critical. Credit risk assessment in corporate bond holdings needs heightened attention. Liquidity management becomes more important as market dynamics shift. The bond market alert is real. As reported by CNBC on May 22nd, the yield surge in risk-free treasuries has bond investors on high alert. The so-called risk-free rate climbing to these levels compresses equity risk premiums and forces valuation reassessments across asset classes. The U.S. bank perspective on how changing interest rates impact the bond market confirms that when yields rise, existing bond prices fall. This inverse relationship means fixed income portfolios holding longer duration securities face mark-to-market pressure. Active duration management isn't optional in this environment. Looking at the yield curve data from Street Stats Finance, the term structure shows where opportunities exist. The curve steepening benefits institutions with asset liability management flexibility, particularly banks that borrow short and lend long. This dynamic drives financial sector outperformance when curve steepening persists. For equity traders, the key insight is that sector rotation is accelerating, not slowing. The normalization of the yield curve historically accompanies economic expansion phases, favoring cyclical and financial exposure over defensive positioning. However, given elevated yields, income-generating defensive sectors also find support from yield-seeking investors. From a trading desk perspective, volatility in both rates and equities creates opportunities for nimble positioning. The elimination of rate cut expectations from futures markets suggests any surprise dovish pivot from the Fed would trigger significant repricing. Conversely, inflation data surprises to the upside could push yields even higher, particularly at the long end where the 30-year is already at 2007 levels. Corporate bond spreads deserve attention. With investment-grade spreads facing pressure and institutional money rotating toward agency mortgage-backed securities, credit selection within corporate bonds becomes critical. High-quality issuers with strong balance sheets maintain appeal, while lower-quality credits face headwinds from both rate levels and spread-widening risk. The current federal funds range of 3.50 to 3.75% sits in what many consider neutral territory, neither stimulative nor restrictive. This positioning gives the Fed optionality, but it also means markets must price assets without clear directional rate guidance. Uncertainty creates volatility, and volatility creates trading opportunities for those with clear frameworks. Bottom line for traders, the Fed pause has reset the playbook. Treasury yields at multi-year highs, futures markets pricing zero cuts, and sector rotation favoring financials and selective value plays. Technology remains bifurcated between quality names and high-valuation growth stories under pressure. Fixed income requires active management with focus on duration, credit quality, and securitized products. Crypto offers diversification, but with elevated volatility. This environment rewards preparation, risk management, and tactical positioning. The data points are clear. The opportunity set is defined. Execution determines outcomes. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.